Welcome to Cashflow Vision. Our today's topic is IPO or Initial Public Offer. Companies can raise equity capital with the help of an IPO by issuing new shares to the public. It is referred to a flotation, which a firm proposes to the public in the form of ordinary shares. Before going public, a company is private and is controlled by the founders and the investors. It is also defined as the first sale of stock by a private company to the public. An initial public offering occurs when a private company raises capital by offering its stock to the public for the first time. The main reason for going public is to raise a huge amount of funds through the different ways that are offered. Public companies usually get better rates when they issue debt, and this is because of increased scrutiny. If there is a decent market demand, a public company can always issue more shares. Trading in the open market means liquidity, and it is the benefit. The initial step in the IPO process is to decide on an investment bank that will guide the issuing company. The company which offers its shares is known as an issuer. It does it with the help of investment bank. IPO is done through the process called underwriting. It is the process of raising money through debt or equity. The underwriters are the link between the company and the public. Investment bank would put together a registration document to be filed with the regulator. In India, it is SEBI. It contains information about the offering, company information such as financial statements, management background, where the funds are to be used, etc., etc. The regulator will investigate and make sure all material information has been disclosed. Once the regulator approves the offering, an effective date is set when the stock will be offered to the public. Red herring prospectus plays a vital role in the IPO process. This is an initial prospectus that contains all the information about the company except the details of the offer price and the effective date. With the red herring in hand, the underwriter and the company would make an attempt to build an interest for the issue. With the red herring, efforts are made where the big institutional investors may be approached for potential investment. But it is also important to know that although an IPO is an opportunity to get into a good company from the beginning, but as IPOs happens once for each company. That is why to avoid the hype and get into an IPO for a good investment in a company after considering all the factors associated with it. I am sure you will find this video quite helpful. Take care, stay safe.